So cash flows, what do I want you to learn from this? It's really a refresh of Accounting 101 cash flows, because it's really important to understand the difference between operating, investing, and financing cash flows. Like understanding how we generate cash or how a business generates cash is key to everything we've discussed about in managerial accounting. Like at the end of the day, if we don't have cash coming in the right way, then we don't have a business. So all of these managerial metrics should be to optimize cash flows. And so we're just going to be talking about the different types of cash flows. Because I have that other video I referenced, I'll go through it relatively quickly without too many concrete examples, and I might use Google Sheets just for one overarching example. And then the big new piece is describing non-cash investing and financing activities and disclosures related to it. So there's many things that that don't have a cash transaction related to it. I also added this as a summary to the video. But for example, if we trade, you give me a piece of equipment and I give you some land, or you give me a building and I give you my car. Like those trades don't have cash, so they're not going to be able to be distinguished in the statement of cash flows, but they have economic value, and so there has to be a disclosure related to it. And then analytical concepts are we're going to be talking about cash flow to total assets ratio. So all these ratios that I expect you to memorize. And then we'll just talk briefly about preparing a statement of cash flows. I have a lot of videos on this subject, but I will just do one refresh just so I make sure everyone's on the same page. It's really just making sure that you have the fundamentals before you go into intermediate accounting. Like you should be able to look at a statement of cash flows at the end of this and understand fundamentally how it's prepared. And if I told you to prepare it yourself, you could at least look up online how to do it and kind of follow along and not be too confused. And then you should also be able to distinguish, if I ask you what's an investing opportunity versus an operating activity, you should be able to know that off the top of your head by now, because it should be your second exposure to it. So what's the purpose of statement of cash flows? From a managerial perspective, it's really how does a company get cash and how does the company spend the cash? Like there's really these two boxes, receiving cash and spending cash. And then we as managers should analytically understand what explains these changes in the cash balance. And so a bookkeeper or a basic accountant should be able to prepare the cash flows. But as you move up, as you become a manager, you should be understanding like, oh, operating cash flow increased because we had a decrease in ARs, which means that accounts receivable, which means that our collections we're collecting money quicker, which means maybe we have someone good in that department who's doing better at collections, and maybe we should promote them or see what they're doing correctly so we can encourage that across the business. So like taking it the step and saying, reading the language of the numbers and figuring out the story behind it, and then using that to improve the business. Importance of cash flows, it really brings us back down to a non-GAAP financial statement. So remember we've talked about a lot of different accounting by now, which I think it was hopefully a surprise to everybody. It's not just like we have GAAP accounting, or it's not like we just have debits and credits. We also have managerial accounting. We also have tax-based accounting. And in this case, each one is a tool that we use to interpret and get different information, because we want to make the information of the world useful to us, and businesses are complex entities. And in order to understand a complex entity, we need some kind of language. And so cash flows help remove the gap. Like, so what's the purpose of GAAP? GAAP's purpose is so that we can compare financial statements to other companies for like investors, borrowers, lenders, whatnot. They want to make sure that they understand how one company performs compared to another. But cash flows tell us if the company actually can survive, if the company can pay its debts, if the company can pay off its investors, right? You can have a high income theoretically and then have still low cash flows, or you could be making a ton of money but not be able to service all your debt. So cash flow should give us a much prettier picture of this, or a much clearer picture. Managers plan day-to-day operations based on cash flows, as we saw through the cash budget, right? The master budget, it's all about cash. And so that's tying that picture together, that we can't do a budget without cash. You don't do budgeting based off income, even though you could like do forecasts and whatnot. You'll hear about that in FP&A and advanced finance classes. You really need cash flow to understand how the business, to plan the day-to-day budgeting and operations, and to make long-term investment decisions. At the end of the day, you don't use revenue to fund your business. You use the cash, right, to buy your buildings. So we learned about that throughout all the class, and hopefully that's making a little more sense now, why the cash flow is an integral part of the financial statements. And there is a GAAP way of presenting statement of cash flows. That's really the point, to take it to a cash basis of accounting instead of a GAAP accrual basis of accounting. And that's because you need that to tie it to everyone's budgets. So how do we measure cash flows? Cash flows, we have short-term investments. We have this concept of a cash equivalence. So we talk about cash and cash equivalents. And so what is a cash equivalent? A cash equivalent is a short-term, highly liquid investment. So it could be cash. It could be anything within 3 months of conversion to cash, or money market funds can be this concept of cash equivalent. So anything that's readily convertible to cash very quickly. So we might have like a money market fund, which generally gives us some kind of return that should approximately match inflation in a normal environment. And in that case, we would report that as cash because we can convert it at win. So we take this cash and cash equivalents, and then we're going to determine how they flow in operating, investing, and financing activities. So you should know all those different activities by now. Is anyone here kind of confused about the fact that we break it into 3 different sections? Every thumbs up if this was covered in the last class you had in detail. Okay. Cool. Helpful. So I'm just going to refresh all of this. What's an operating activity? The point of an operating activity is something that helps us generate part of our normal business that generates our income. So if I'm a consultant, an operating activity would be anything that helps me make a sale to a customer. Or if I'm a retailer, it's me selling the individual good. So there's generally this operating cash flow cycle where we take cash inflows from a customer, from collection of credit sales, from receipt of interest or receipt of dividend revenue. And then we have outflows relating to our operating expenses, to any like quick taxes or interest owed. What this really is, operating activities in our business are really primarily related to short-term assets and short-term liabilities, which makes sense, right? That anything in our operation should happen quickly. And so anything related to operating activities is generally changes in accounts receivable, a short-term asset, accounts payable, your short-term interest revenue, that kind of stuff is very operations focused. Note that I'm going high level concept here. There's actually a lot of nuances. Like, is interest actually an inflow from operating or financing or investing? That's actually a pretty hotly debated topic. I'm not going to go into the exact answer here because it's not a financial accounting class. I'm just trying to get you to the concept. And so it's going to be more helpful for you to understand if you get the concept that gets it right 99% of the time. Because know that accounting is a judgmental based field. This is a language, and language is subject to interpretation. So overall, if I get you leaving thinking that operating activities is short-term asset, short-term liability, or anything tied to the income statement, like revenue loss, then you're good to go. So if I say, oh, accounts receivable went up $100,000, that's an operating activity. And then you can take it one step further, and then you just have to understand the logic. What does it mean if your account receivable went up by $100,000? What does that mean? Anyone in class?
That means you have negative sales.
What was that?
Less cash came in.
Yeah, someone owes us $100,000 that we didn't yet collect. So that means that our cash flow is actually down $100,000 if we're using it from an indirect method. Like our income would be higher than our cash flow if we're recognizing income at the same rate as accounts receivable. Does that make sense? Good job. So that's how we can use that information to interpret cash flows. And so that's something counterintuitive, right? But if you understand now after this class, like cash flow is important. And even though if we get higher accounts receivable and sales, but we're not collecting cash, that's actually a problem. Because we need that cash to buy our inventory and whatnot and generate our business. Investing activities, I think of just as long-term assets. That's how you have to think. Any of your long-term assets are going to be 99% of the time going to be investing activities. What are your long-term assets? Your plant, property, equipment, your land, your long-term bonds, or your long-term stocks that you're holding. The principal you collect from these long-term investments. And your intangible assets, like the property rights you buy, or intellectual property rights. And then your cash outflows is any cash you use to buy such things. So the sale or purchase of long-term assets is your investing activities. And your financing is your sale or purchase of equity or long-term liabilities. And so I have a slide. Let me open up my other slide here. I'll try to remember it. Cash flows. The right one. So I'm switching back to, this is my own slide. I like this. Classification. There's a balance sheet, your operating activities, your current assets and current liabilities, 99% of the time. Investing activities are your assets, long-term assets, and your financing activities are your long-term liabilities and equity. Does that make sense? If you leave remembering this is going to be very helpful for your quizzes. So I'm switching this slide because I like my own slides better in this case. So examples of operating activities, you can look at these slides. I'll share them where you can, like, inflow is cash sales to a customer. Operating activity outflow is paying supplies for goods or services. And these are the things I can test you on. What you'll see in the test bank is what's an inflow, what's an outflow. Inflow from investing might be selling your property and plant and equipment, while your outflow for investing is buying. And your example for inflow of financing is reissuing treasury stock or common stock or preferred stock, issuing stock and getting cash in exchange. While examples of outflows are generally dividends, like long-term dividends. And paying withdrawals. I mean, like just dividends in general, like your reduction to equity. But then there's like a dividend payable amount, right? So if you have there's a liability component that might flow into your outflows from operating from a managerial perspective. So also remember the difference between financial and managerial. But then there's this last disclosure that I want you all to remember, this non-cash activities. So we can't explain everything in cash. Like I explained earlier, we might have issues where someone converts their equity into their debt into equity. They might have a conversion option where they can retire their debt and instead get equity, or a company might issue debt to pay something or issue equity instead of paying cash for it. That's where you hear like stock options granted, or if you hear of a company purchasing another company, but through their equity. If they convert preferred stock, or if you purchase long-term assets on a note, right? Like if I bought a building with a mortgage, I didn't really switch any cash. Like I might put my down payment, which is a cash outflow, but what about the debt itself? All of this has to be disclosed on the financial statements to get a full picture. And so you can imagine putting one of these together is quite hectic. So let's talk about how do you prepare it. So the format of the statement of cash flows is always the same. Cash from operating, cash from investing, cash from financing gives us our net increase or decrease to cash. And that increase or decrease plus the beginning should equal the ending. That's it. Which makes it, all we're trying to do is figure out what was in our bank account. You literally go to your bank account, the company's bank accounts, and say, hey, what was the ending balance in the bank accounts? And then you reconcile that to GAAP or whatever you might need to do to get, sometimes our cash balances are a little different than bank because bank has errors. That's the bank reconciliation process we talk about in Accounting 101. And then you compare that to your ending cash balance on your balance sheet. That is also, proven through the reconciliation process. And then you're trying to see, so this changed. If this was 100 and then this was 200, it changed by 100. you're seeing why did it change? Did we have it from operating, investing, or financing? And then we have an explanation for that. So then looking at this as outside investors or managers, we can then make some educated decisions to how the business is doing. For example, let's say a company had, this is where you can eventually get to when you see enough of these things. Let's say a company had negative operating activities, lots of financing activity. So had a lot of negative flow from operating activities, a lot of negative flow from investing activities, but then a ton of money coming in from financing activities. What would that tell you about the business? Any thoughts?
Could you please repeat that?
Yep. Let's say we had lots of money going out for operating activities. So we had negative operating activities, negative investing, but then positive financing activities.
Oh, we were buying too many like investments.
Well, it could be that, or it could be we're a startup. A good thought. Like we're buying a lot of investments, and then that's generally like the startup feel for a company. So like if you looked at Tesla, that was very much Tesla. That means that you're getting lots of equity financing or debt financing, and you're investing a lot into your assets, long-term assets, to hopefully cut a profit eventually.
All right. Okay.
Does that make sense? Well, like if we flipped it, what if we had negative financing activities, positive operating, and positive investing? That's normally the profile of a very mature company, or like they have saturation in the marketplace. They don't need to invest more. They're trying to sell some of their investments in order to pay off like extra equity. So they like might buy back stock. So you can like tell a lot from the patterns of how this flows. Well, if you had like a positive operating activities, and then a healthy company would generally have positive operating activities, positive financing, and negative investing, which means like, hey, they're profitable on their standalone basis. They're continuing to invest in their business, and other companies are willing to invest in them. That's like a very just generally healthy after the startup stage company. So just different ways that the cash flow is very helpful. Yeah, good for investment. So how do we prepare the statement of cash flows? We just talked about it, net increase or decrease to cash. That's this part. Compute net cash from operating, from investing, from financing, and then we prove it by checking our bank statements and doing our reconciliation. So I just want you to know the general flow. I'm not going to ask you on the final to prepare an indirect statement of cash flows or anything like that. I'm going to ask you to do a refresher on your homework just because you need to know that indirect method. But that's what my video is for, to help you through. I have a whole series of videos where I walk through a statement of cash flow. So I just want you from this class to understand more that how we analyze the cash accounts. So cash account is one of the best places to look for operating, investing, and financing activities. So here we could see the cash balance. You imagine this is relatively small. If you were working for a place like Facebook, these would be in the hundreds of millions amounts. And then you can imagine how complex it is. How many people here eat out at a restaurant at least once a week? Or get at least a sandwich or something? Cup of coffee at Starbucks. Okay, a few people. Imagine now you have 100,000 employees who are all doing that and putting on a company credit card. Like this cash balance account can become nonsense pretty quickly, right? And then you're also buying business expenses and supplies. Like how do you analyze that? So it's not going to be this clean in practice, but I'm just taking it away. Like as a manager, you would get a summary, and that's what we're going to be looking at, the summary. So, okay. The cash is, so we can naturally see here in the cash, like what we paid money for. We should summarize that. And then this is one way to do it for a small company. But for a small, most of you are not going to work in small companies. You're going to be in the Silicon Valley. So unless you're going into a very, very new startup, even new startups here get tens to hundreds of millions of dollars in financing. And so the easier thing to do is analyze non-cash accounts to then get to an approximation of what the statement of cash flow should be. And a lot of like bookkeeping systems will help you do this. Everything from QuickBooks to like SAP. But what you do is you'll have your cash. We remember cash equals liabilities plus equity minus non-cash accounts. So the idea here is that we can use, this is just going into the indirect method. So we can use comparative information in order to figure out how our cash flow changed. So all we need to know is what we have to have 2 years of balance sheet information and 1 year of income statement information. And then we can create a statement of cash flows. And so here's just the difference between indirect and direct method. A refresher for those who don't remember. GAAP recommends using the direct method, which that means that we look at every receipt, or we process every receipt, we look at the cash account, and we determine what bucket the cash accounts go into. Like I said, that's impractical for most large companies, even though the FASB prefers the direct method from theory. Every company uses the indirect method. Like every large company that I'm aware of, like 99% of companies use the indirect method because it's just impossible to look at all their subsidiaries' cash accounts. And so what they do is they take their net income. So they prepare their GAAP financial statements first. Remember the flow of incomes, the creation of financial statements. We have the income statement goes to the balance sheet goes to the statement of equity statement. Then you use all of that information because now you have your comparative information to create your statement of cash flows. That's the general flow of information. And so we take the cash flows from operating activities, net income, right? That comes from our income statement. And then we look at our balance sheet and our statement of equity, and we compare how these accounts change. So in this, we note that, accounts receivable increased 20,000, which means our cash flows decreased. Our depreciation expense, we spent 24,000 depreciation, but we know in practice that's not a cash expense. That's a non-cash expense. So we add it back. So we look at the changes in these balances, plus we look at non-cash expenses and revenue, and then we bring it back to figure out how much cash was from operating activities. So let's do this in detail. I'm just going to walk it through. I'm not going to do this in Google Sheets today because I think it's easier for me just to talk through it for everyone, and then you can watch this again. This is really me just explaining the logic to the increases. So we get an income statement, we get a balance sheet, right? This information will be given to you. In addition, we have all of these notes, because this isn't enough. We need to know if there's non-cash activity and the dividend payable and all of that fun stuff. The first thing I would do is take our assets, liabilities, and equity, our comparative information, and calculate out the change. So I take cash minus from the 17,000 minus the 12,000, the 60,000 minus the 40,000, and just run that down. Like this is equal to this minus this. That math is here: 5,000, 20,000, 14,000, 2,000. How did these accounts change? Then I'm going to analyze it by applying the indirect method. So first thing, depreciation expense, the 24,000. Depreciation expense is a non-cash expense. Stop me if someone needs a refresher on this. Depreciation is a non-cash expense because remember, we spent cash for the asset originally, or we had debt, and then we depreciated over its useful life. While we depreciate it, what is a journal entry? Debit depreciation expense, credit accumulated depreciation. There's no cash in either of those. So these non-cash expenses have to be backed out of the statement of cash flows, right? We have to add it back because it hit the income, right? This income has already been reduced. This is net income by this 24,000, but that doesn't reflect the cash reduction. So we add it back. Same thing with a loss of plant asset. So it says here, $6,000 loss. We sold the plant asset of 8,000 for 2,000. So we incurred a $6,000 loss. That $6,000 loss isn't a cash loss. It's a GAAP-based loss because we just didn't have enough accumulated depreciation on the books, right? So our loss would be debit cash, whatever the balance of the cash is. That's an investing activity because we sold a long-term asset. But then the loss goes into net income. So we debit cash, debit a loss, credit the asset, debit accumulated depreciation, and the balance of all that is the loss. And that the loss here would be $6,000. Because that loss is a non-cash based loss, it's a GAAP loss, we add that back. Because that loss is reflected in the net income statement, but it's not reflected here. It's not a cash based loss. So we add that back. Same thing with gains. So we retired notes, we did our journal entries to the notes, we received a gain on it, but that first thing is a long-term note is an investment that we sold. So that's the principal we received back as an investing activity. And then the gain is reported in net income, and increased net income by 16,000, but it's not related to cash. So we reduce it. After we do the non-cash based activities, we go and look at the changes in current assets and liabilities. So accounts receivable increased 20,000. That means we collected less cash, so we decrease it. Increase in inventory by 14,000. That means we paid cash for it. So right, we debited inventory, we credited cash. That inventory, right, is capitalized. We didn't have a cost of goods sold related to it yet, so it's not yet reflected in income. That's why we're reducing it here. We're accelerating that reduction. Increase in prepaid expenses. That's cash we paid out that hasn't been expensed yet. That'll reduce it. Decrease in accounts payable. So we paid for some accounts that haven't been expensed yet. There we go. We subtract that, and so on and so forth. Decrease in interest payable, and then an increase in income tax payable. If you add all this together, we get $20,000 of operating activities. So we already talked about this, not affecting cash. There's this summary. Here's a shortcut. I don't like this shortcut. If you need it, if it's just a way for you to survive the class, use it. But then you don't understand the material. Like, I really want you to you all should be able to think through and understand that if a current asset increases, we need to subtract it from net income because it's inaccurately reflecting the cash flows. But if not, you can just remember current assets. If they increase, we subtract it from the operating activities, and we add if it increases, we add the current liabilities. So you can kind of remember this matrix. We decrease current assets, we add it to net income. We decrease current liabilities, we subtract it from net income because we're paying for those liabilities. Yes, Michelle. Question?
So basically, for this chart, how do we know when it's increasing or decreasing?
Good question. That's from this step here. So you'll get the information 2019 and 2018 comparative balance sheet, and then you calculate if it's increased or decreased.
Okay.
Make sense?
Yeah.
Okay, good question. Thank you. Okay, we talked about the adjustments. That's what we just walked through. And say, here's a summary. Here's a conceptual summary, right? So for our operating activities, we add back non-cash expenses and losses. We subtract out non-cash revenues and gains. And then we make these adjustments based on the matrix. So whatever helps you, if you appreciate the narrative format, if you appreciate the visual format, or the way I prefer is a logical format, like understanding the logic behind it. Because if you understand why you're doing it, then you can kind of solve for everything. And if it's not clicking yet, that's okay. I think accounting didn't click for me until like my more advanced accounting classes, and most people the more repetition you can, it's the language, eventually you'll start speaking it. So it's easy right now. You started seeing it so many times. It's been a year of you doing this. It could get a little frustrating. That's normal. That means you're about on the cusp of a breakthrough. So give yourself another year, and eventually this will continue to make sense, but keep working through it. Let's see. So next, investing activities. We figure out our investing accounts, we explain the change in these accounts, and report their cash flows. So here, when we did our comparative balance sheets, from what Michelle astutely asked how we recognize changes, well, we saw that plant assets increased by 40,000 in our comparative balance sheets. And so we see this 40,000 increase where our plant assets increased from 210 to 250. We also see a 12,000 increase in accumulated depreciation. So long-term assets are always have this complication, right? Like there's these hidden things happening in the transaction. We have depreciation moving the balances. We're purchasing plant assets. And we also might be disposing or selling of plant assets. So we need to get like additional records in order to find all of the activity and then reconcile all these changes. And in practice, what that looks like is normally a workbook. You'll have like a Google Sheets or an Excel, and you'll have all the records, and you'll say, here's all the changes, and you'll kind of explain it and show how cash changed. So this is what they're doing next. They get all those records and they say, oh, well, we actually built up 60,000 in assets for notes. We also sold some assets. So these will be our invoices we find. And we also have this depreciation expense. So we take all that information to figure out our cash flows from investing activities. So we sold some, right? We received $2,000 for a sale. That's what this entry is. So that would be a sale. That would be income from investing activities. We have a non-cash component that needs to be disclosed because we have the note that we issued, the $60,000 note we issued. And then we also have the overall, we have the 60,000 note, and then we have our depreciation expense, which showed our change in accumulated depreciation, but the depreciation expense was a non-cash based expense, which we added back already in operating activities. So that's really how we get back to our statement of cash flows for investing. So see how that 40,000 increase, that doesn't mean that because it's a long-term asset, it doesn't mean we just spent $40,000 more. That's not what happened at all, right? What actually happened was we had cash we received of 2,000 on our statement of cash flows, and then a non-cash activity of 60,000. That's very different than we anticipated, right? Does that make sense? So we need to look at the underlying records to see how that changed. Same thing for financing. So we're going to look at changes in equity and notes payable. So here we have an increase of notes payable of 26,000, which means in theory, we should have received $26,000 in cash from financing activities. But we need to look at the note. What actually happened with the note? Well, we had a few different notes, and the notes had a carrying value of $34,000, some of which we paid and retired for $18,000 cash, and we received a gain for. Remember, this gain we recognized on our operating activities, because gain is the reconciliation of net income. Our operating activities are the reconciliations of net income. So what we really need to see is, well, how did cash move? Well, we paid $18,000 cash. So that $18,000 cash we paid to retire the notes is a cash outflow for financing activities, even though we show a 26,000 increase in long-term notes payable. Then we also have to look at our common stock transactions. So our common stock transactions, we see that we do our comparison. We got $15,000 more in common stock. We look at what happened there. We received cash for it. So we received cash for issuing common stock. And then we look at our retained earning. We have cash we paid for dividends. So we reduce cash out of our retained earnings. So that's going to be a financing activity because it reduces equity. And then we prove it all out. This is my favorite thing about accounting is you know when you're wrong. And so we then take all of these numbers that we then calculated. I walked us through the calculations, the theory of the calculations. And then we figure out our net increase in cash, which is just our operating activities, right? Which is our net income versus the non-cash, and then our changes in current assets and liabilities. That's our operating activities. Then we add back our investing activities. We reduced it by our financing activities, and we get a change of 5,000. Well, we know from our bank statement reconciliations what our beginning and ending balance should be. And so the increase plus the beginning should equal the ending. If it doesn't, we messed up our statement of cash flows. We go back and figure out where we messed it up. So there's these internal checks, which are very nice. So you always have the beginning balance, the ending balance. So you just need to make sure you figure it out how you explained the movement of the middle, right? Does that make sense? You can also use this with T counts. I'd say this isn't, you're going to use this when you go into more advanced accounting, when they make you do it live in person. Like, so for your CPA exam and and normally for your intermediate accounting classes, they're going to actually have you prepare a statement of cash flows from scratch with all the different information generally. It's a requirement, and T accounts are a useful way to make sure that everything stays balanced. In this class, I think that you can use Google Sheets and everything. It's a little more applicable, so I wouldn't worry about it. Just remember that we learned about T accounts in Financial Accounting 101, and you can use that to make sure that everything, you're reconciling everything. It's a good tool. So let's talk about one tool you can use to analyze statements of cash flow. This one tool you can use is the cash flow from total assets. So you can look at cash flow on total assets by taking the operating cash flows divided by average total assets. And that just helps us compare other businesses or business units. So we can take, like, let's say we had two businesses and one had 100 million operating cash flows and 20 operating assets. You'd have a 5. The cash flow on total assets would be 5x. And so you'd be able to say, wow, they generate a lot of cash flow from their assets, while other companies might generate very little cash flow from their assets. So it's just a way to measure company performance. Other ways you can use this to make comparisons between companies or different divisions of your company. And so the thought here is, like, we can look at, we have a BMX, an ATV, and a Trex division for our company. And we can look at operating, investing, and financing activities to learn. And I already talked through this. We can see each stage. So we can see the BMX gives us a lot by operating. We're investing a lot in it. And we're selling off financing activities for it, which means it's probably a more mature business that we're trying to grow. ATV, we're not spending any financing on it. So maybe it's a less mature business. Or it's a more mature business and we're kind of just continuing to scale it. And then here, this is our Trex is probably our startup division, because we have a negative cash flow, but we have we're selling off some other assets to grow it, and we also have some financing activity. And then all of these have the same net increase or decrease to cash, but like, what would you rather invest in? I'd probably say this looks the most this looks like the best industry for me to invest in, the BMX, because it provides a lot of cash by operating activities, and it has a lot of promise. So no, like, just because cash changed, I would probably want the most to invest in this. I'd want the least to invest in Trex. Trex is the riskiest. And the last, we've talked about spreadsheets a lot. And the direct method isn't used in practice, so I wouldn't worry about it. You might be asked how to do it by the direct method in a more advanced accounting class. It won't be an expectation in this class. So that's it. Are there any questions? I told you all that this class and the next class will be relatively quick refreshers. So as promised, this will end early. So I want to make sure, are there any questions, anything you'd like me to recover? If not, I'm going to go over the interview questions, and then we'll be done by 10.
Professor, I've got one about, you mentioned the direct method isn't going to be really used in practice, right?
Yep.
But we will have to worry about it potentially for more advanced accounting classes. Does that mean we'd also have to worry about it for like the CPA exam?
Just that generally they'll ask you how often it's used. You're normally not going to have to, they might test it, but it's very, very, very rare. Okay. And there's a lot of materials that'll prep you for it. So it's an expectation that you just know about it. And the whole concept of the direct method is you're not using comparative financial statements. It's more of this, what they call the shoebox method, where like if you had a startup company that never had a financial statement done in its entirety, you would have to look through all its receipts and then classify each receipt. But with that, you have to like look at it at a transaction level, and most companies just don't do that. So.
Okay, well, that makes me feel better about it. Thanks, Professor.
Yeah, no worries. Good question. Any other questions? For tax accounting, it's a lot more used. So eventually, but then there's going to be a lot of tax classes, because if you have an individual who comes to you and has like a very small business, they might come to you with a shoebox full of receipts and say, here's my business, figure it out. And you kind of sort out the receipts. Oh, here is an operating, here's investing here. But that's like, my guess is 99% of you, we're in Silicon Valley. We're going to be going into doing taxes or finances for corporations, not individuals. And that's what this class is about anyways, too. If you're interested in that more, you'll also take an individual taxation class in the future.